Hey there, everyone. Dave Keller with Market Misbehavior, and thanks so much for joining me here on the latest episode of our Market Misbehavior podcast. The goal of this podcast is to sit down with top market practitioners, traders, analysts, strategists, investors, authors, educators, anyone I can find that's willing to sit down and talk markets. I'm excited to do so. And it's a joy to speak to someone like today's guest who has the knowledge of technical analysis, knowledge of trend and momentum and breadth and sentiment, as evidenced by his CMT designation, which I hold as well, but also spends much of his time talking with sort of non-technically oriented investors, a lot of financial advisors who may or may not be familiar with some of those techniques. And, talking to someone who spends their time translating, some at times more obscure analysis of price data, but then helping people who are less familiar understand and apply those techniques is a rare skill. And I think today's guest, Adam Turnquist, who's the chief technical analyst at LPL Financial, certainly fits that bill. So at LPL, it's one of the larger advisor networks here in the United States. And Adam's job is to help their advisor network, help the advisors, those who manage others' money, help them understand market conditions and have reasonable expectations about what may come next. And I think what you'll find in my conversation with Adam Turnquist, he's a market historian, and I've found that charts are just one of the best ways of understanding market history and just quantifying what has happened and have an educated guess about what may come next. It's all about analyzing historical cycles, right? Bull and bear cycles, seeing what the conditions have looked like, seeing what has happened going into those major peaks and major valleys, what has helped us understand that those periods are over, and how we see a change of character on the charts. We'll talk a lot, and you'll hear our conversation focusing on expectations for 2025, and a lot of that is through the historical lens of 2024 being an exceptionally strong year. I think Adam did some really interesting, unique work comparing 2024 to other previous bull cycles, and really focusing in on some years that have as many similarities as possible with what we experienced last year. I'm immediately comparing 2024 to 2021 because similar uptrends, similar low volatility, similar strength, and it's easy to assume that 2025 is going to be a lot like 2022, which was a bear market year after a raging bull market phase. But I think what you'll find from our conversation, maybe that's not the best comparison to be made. And I thought he had some interesting comparisons to the mid-90s, to the late 1950s, and looking at some of the charts and technical considerations about some of those periods. We talked a lot about stocks, a lot about breadth, a lot about key levels to pay attention to as we're having a choppy start to the year here in January 2025. But we also talked about interest rates. We talked about the strong U.S. dollar, talked about leadership themes and offense versus defense, large versus small, growth versus value, and a lot of other things as well. A lot of topics covered, and again, I think Adam does a really good job of digging into the data, but then helping it be relevant and make sense to the present day. So please enjoy my recent conversation with Adam Turnquist of LPL Financial. All right, so it's really good to be sitting down here virtually with Adam Turnquist of LPL Financial. Adam, Happy New Year! Hope you're doing well. How are things on your side? Okay.
Things are going good, minus the Vikings loss last night. Unfortunately, I stayed up watching that one, so a little tough. Got a sick kid at home as well, so I'll be drinking lots of coffee this week, I think.
So the non-financial things are presenting some challenges. I wasn't going to bring up the Vikings. I wondered if you were a fan. So, okay.
Unfortunately, I'm a Vikings fan. Living in Green Bay, which is even more interesting.
Okay, things could be going better. Arguably, market-wise as well. I would say that the market's obviously struggling a bit here going into the new year. We have a bunch of charts to go through, but kick us off. Just give us your overall assessment. I mean, 2024, obviously an incredibly strong year. Toward the end, I guess, started to be some question marks going into the holidays. Now, all of a sudden, January is opening a little weaker. Where's your head at in terms of the overall conditions here in January?
So when we look at the market on a shorter term basis, we started to see, we'll call it cracks underneath the surface. I think as most technicians did, really as we rolled into December, we had this big post-election rally, things broadened out, and then some of that breadth in the market started to dissipate. The mega caps did a lot of the heavy lifting for that rally. And we're starting to see the market break down a little bit technically, some short-term pain. We're still in a longer-term uptrend above a rising 200-day moving average. So I put a lot of weight on that. But when you add up some of the collective evidence here, the market dipping below its 20, 50-day moving average, some new 12-month lows and some of the breadth measures, I think it does suggest we could have a little bit of short-term pain here, perhaps maybe even down to the 200-day moving average, for example, on the S&P 500 as we kick off 2025. Not the greatest message to start the year, but I do think eventually it will be a buying opportunity for equities.
So, we're looking at your chart of the S&P 500 with a couple indicators that you included in a recent report here, which is super helpful. Talk to me, if you could, just a little bit about, obviously with the short-term weakness that you mentioned, some of the signs of deterioration, how do you think about potential levels, price objectives, right? Thinking here's where we may find support versus just defining the trend. How do you think about trend versus, I guess, targets or objectives?
Right. So when we look at just the current technical setup, we can use that to get a price objective. For example, on the S&P 500 here, we'll call that a head and shoulders top formation. You can see the left shoulder head and right shoulder as you're highlighting. The key to those, David, as you know, you have to break the neckline for that to be valid. And we did break the neckline last week, right around 56 or at 58.60. We traded below that. We've had a little bit of an intraday relief rally kind of fizzling out around that level. So when you measure that head and shoulders top formation and you apply it to the neckline that recently was violated, that gets you down to a downside price objective right around, I think, 56.30. So that's kind of in between those July highs for the broader market and then the 200-day moving average. So that's kind of the downside that we're telling our advisors here at LPL in terms of expectations. And then, of course, we're still above that longer term trend. So we'll see how the market behaves if we get down to those levels, if there's buyers that come back in. I think that could be a potential spot to buy the dip.
And it's interesting as there are a lot of charts I'm excited for people to see, but obviously 2024 is so strong, immediately makes me think back to other very strong years and kind of what happens afterwards. When you did some digging into I guess 24 into 25, what sort of historical comparisons stood out to you?
So as technicians, we're always looking at history to help us maybe guide us a little bit into the future, give us some expectations, and a lot of times we'll use chart formations. For example, that head and shoulders pattern, we often look for those. And I also turn to data and look at statistical periods that resemble prior periods. And each probably 6 months, I go through this exercise and I look at, for example, how 2024 stacks up compared to other years. So I look at the price progression of the year, and then I run a correlation analysis all the way back to 1950 for each year to really look at, okay, what years really statistically looked like 2024. And you can see here the correlations throughout history. And some of the years that stick out early or mid to late 50s, 1995, that's been widely used as an analogy right now. That was a soft landing period, a lot of record highs. Of course, the dawn of the internet is being the analog there is, of course, with AI coming out. And then later we had 2013, 2017, and then 2021, all with correlation coefficients north of 90. And of course, as you know, context is key when you start to look back at these periods. We did that as well. And I think that's on the next slide, just to give us a little bit better framework of maybe what years out of those look closest to 2024. And this is kind of shooting from the hip a little bit. There's not a lot of science here, but of course, 1995, as I mentioned, you had the Fed soft landing. 10-year yields were lower during that period, inflation moving lower, no recession. Next year, you had a 20% return. And then also 1958 looks similar in terms of a macro environment, in terms of what the Fed was doing, inflation. You did have a recession early in that year, but I think that ended in April, and a solid 8.5% return coming out of that year. Of course, you do see 2021 on there. We'll talk about that chart in a few minutes, but those are kind of the closest analogs I think you can make based on data, just the correlation data, and then some of that macro backdrop to what we witnessed last year.
This is such a helpful comparison, because I feel like for me and others, right? What happened most recently is what comes to mind. And I'm immediately thinking of 2021 into 2022. I'm thinking of 2017, which went into 2018, which, had some pretty painful experiences, particularly at the beginning of the year. But again, kind of a deeper analysis, comparing some of the other macro conditions. I really like some of those comparisons. Does this give you a reason to be a little maybe more optimistic than some may be, given the strength of 24?
I think so. Of course, we're hoping for a 95, 96 type time frame. And of course, maybe that alludes to the whole 90s era. But I think realistically, when we look at the momentum we witnessed over the last couple of years, we have to be, realistic about this year and maybe having a little bit more of a normal type of return year. And then return to volatility is another call for us as we go into 2025. We had very low volatility last year, very limited drawdowns. So I think volatility, as it tends to do, will mean revert, and we'll have a more volatile year, I think, for equities. That's certainly been the case the first couple of weeks here.
I want to talk a little bit about the conditions that we could be, I guess, experiencing given some of these historical comparisons. You have a couple charts that I think are interesting. One, looking at some of those previous years and kind of sort of what played out, and then also looking at 2021. Can you talk us through these two?
So let's go with the good news here. This is kind of the maybe best case scenario, right? And this is a price progression of the S&P 500. The current one is in dark blue. You can see that's last year rolling into the new year here marked by that horizontal or vertical line. Mm-hmm. And then we're using the progression of 1995 into 1996, and then also 1958 into 1959. And what on immediate, on a near-term basis stands out here is both of those periods, you did get about a 5% kind of pullback as the year kicked off. And in 1958 to 1959, it was a first quarter. In 1995, it was almost immediately as you rolled into 1996, you had this pullback. And of no surprise, those were, pretty good years for the market. Things may be a little bit overbought. When you look at maybe the best case scenario using that 95 to 96 transition, I thought it was interesting because you had this kind of rally off the lows, but then the market really did nothing for most of the year. It just consolidated there in the bright blue. And most of the gains in 1996 were attributed to the last quarter, that year-end rally that we witnessed. So maybe that's a sign of what to expect, at least over the next few months here for the market. I don't think that's a wild call to make, just given some of the technical damage that we're seeing, where the interest rates are moving, where the dollar's moving. And I think that gets us to 2021, maybe the worst case scenario for equities, because as we look here, that 2021 period, very highly correlated to price action last year. As we all know what happened in 2022, I think we started off the year with a record high, and then it was all downhill from there. And when you look at the macro backdrop and the field conditions that you're playing on, there's some similarities as well that makes me a little bit cautious here. Right now, you have 10-year yields breaking out. Back then, you had yields moving higher. That's the progression of 10-year yields in that middle panel. The orange is where we're at now, and that purple panel is how yields progressed back in that time frame. And then let's not forget about the dollar, especially when you think about the earnings that come from abroad in the S&P 500. Around 40% of those come from abroad, and a lot of that is in tech. That is the highest percentage of foreign revenues. So when those get repatriated to the greenback, that tends to impact earnings. It's going to be really interesting to see what kind of commentary we get from corporate America surrounding the dollar, because when the dollar was rallying in 2022, we did hear a lot about the dollar headwinds. I remember doing analysis on how many times the C-suite mentioned dollar headwinds in some of our research, and it was certainly abundant, we'll call it. So those macro conditions make me nervous as well. They're certainly, in my opinion, not conducive to a quick rebound or a strong rally or north of 20% as we witnessed last year.
It's a really interesting chart. And again, I mean, comparing 2025 potentially to 2022, I feel like as 2022 started, so many things changed, right? It's like 2021 had a certain look and feel. It's like the moment you flip the calendar, everything felt very, very different. And to your point, I mean, strong dollar was key. Bonds selling off and yields going up so much were pretty important. Are those the most important things to be watching here then, in terms of, if you're concerned about the doomsday scenario? Is it a stronger dollar with, tech? What, a third of the S&P 500 is probably technology at this point? Is that the biggest risk here, do you think?
I think the backdrop for rates is really dictating how equity markets behave. And it has changed that relationship over the last month or so. When you look at just the correlation between stocks and bonds, it started to change as yields, we'll call it, move past this pressure point. We called that level about 435. That goes back to those October 2022 highs. It also lines up with a downtrend that's been in place since then. So once that downtrend was reversed, the evidence clearly moved to upward risk for 10-year yields. And really, that's where equity markets have struggled. Now we're through 450, through 474, talking about a 10-year that could possibly retest those 2023s at 5%. And until there's at least some consolidation or stabilization in interest rates, I think it's going to be tough sledding for equity markets on a near-term basis.
It's interesting. Another chart we have here is just looking at the concentration in the market. I feel like for a long time, I feel like we've been talking about the challenges of narrow leadership and the Magnificent Seven driving the returns. Didn't really seem to matter because the benchmarks were up just fine. And even if you just accepted that and just went along for the ride, you probably had a pretty good year last year. What is the concentration in the market, or I guess the continued outperformance of the Magnificent Seven now going into 2025? What does that mean for positioning here?
It's the same story. We've been talking about it, as you mentioned, for a couple of years now, this concentration risk. And with the Meg 7 leading the way, doing most of the heavy lifting for the year-to-date returns last year. And now when you look at the technical setup for the equal weight Meg 7 here, it's, as I mentioned, hard to get bearish on the broader market. When you think this is about a third weighting within the S&P 500, we're not really seeing any major breakdowns here. We're just simply pulling back. We'll call it off overbought levels. The trend is up. We're just getting back to maybe the 50-day moving average. That 200-day moving average is a long ways from current levels. And then when we compare things on a relative basis, as we do in the bottom panel, we look at the equal weight Meg 7 versus the equal weight S&P. So the average mega cap versus the average S&P. And you can see that leadership trend stalled throughout the summer. That was a little concerning, but we had the Meg 7 reassert itself into year end. And now it looks like we're just breaking out on a relative basis as well. So absolute basis looks constructive. The relative basis looks constructive. Hard to make the call that the Meg 7 leadership has been lost at any point here.
Yeah, and to your point, how bearish do you want to be when these charts are kind of going up and to the right? I mean, that's essentially the market, right? That's the strength of the market. And I was flipping through your charts before we started, Adam, and the comparison of these two slides just jumped off at me, which was the relative performance, just incredibly strong, of the mega cap growth stocks. Right after that, you flip that over and you have the equal weighted S&P continuing to underperform, right?
Yeah, it's been a continuous underperformer. There's been little fits and starts here of relative performance here for the equal weight S&P. And we're at a point now where you could see, I think, a logical spot where a bit of a bounce. You can see on that bottom right, key support level for the equal weight versus the cap weighted S&P 500. That's where we got a bounce earlier, call it mid 2024. So maybe there's a little bit of room here for some pickup in relative performance for the average stock. On the top panel, you can see the breakdown has been a little bit more severe, a likely retest of the 200-day moving average for the equal weight S&P 500 as it's violated that shorter term uptrend. But still, we're not seeing significant breakdowns here. Technically, it does look more like a pullback or potential correction here, not the start of a bear market.
The chart of the equal weighted S&P reminds me a lot of the like the Russell 2000 index, right? Russell 2000 back testing the 200-day while the S&P and the NASDAQ aren't really there. People have speculated about small caps taking on more of a leadership role at some point. Do you think that day comes at some point? Because it hasn't yet, right?
It's been tempting to make that call, but when you look at the relative trends, as we like to do, and the macro backdrop, of course, with rates, we're sticking with the large caps. That's been the trend, despite, if you flash back to December of 2023, all the excitement about small caps. It's going to be the year for small caps, and it never really played out. We had a nice rally into year end, but that longer term large cap leadership trends continues to reassert itself. We witnessed that in the spring. We witnessed that in July of last year. Even in this post-election price rally, there's, again, more excitement about small caps. But once that large cap leadership trend found support, it's been a large cap leadership story since.
Another chart that this is one that we talk about often on my show is the offense versus defense, and just we've really not seen any significant rotation to defensive sectors. Are you seeing any sign of that sort of rotation in your work or no?
It's almost been the opposite. I've been
Yeah.
surprised by the lack of flows into areas like consumer staples. They're breaking down not only on an absolute basis, but a relative basis. Healthcare, very similar story. And here, in terms of that offense versus defense, a great chart, the equal weight consumer discretionary versus equal weight staples. So are the stocks that are tied to consumers buying things they want versus need a good, I think, tell into the macro backdrop and the economy. And this is actually breaking out to new highs here. I was a bit concerned as we went into that major area of overhead resistance that we'd get some type of potential capitulation. And no, it just continues to move higher. And you can say, well, this is Tesla doing a lot of it, but no, it's an equal weight basis. So it's just the average consumer discretionary stock. Looks very constructive. The relative rotation graphs that I know you use do not really show any signs of a defensive shift as well. So again, more evidence that we think this is pullback correction territory at this point versus the sign of anything more.
So and I think that those are great points, Adam. So trying to differentiate, which I think a lot of us are going to be trying to do, right? A short-term pullback that ends up being very buyable versus a 2022 style, just, 7 to 8 to 9 month deterioration. Differentiating, scenario A versus B, is it that rotation to defensives that would help you sort of assess, okay, this is more of a broader decline? Is it a breakdown of a certain key support level, like the 200-day? What would tell you, okay, this is not the time to buy? We need to really think defensively.
It's a combination. I think a break below the 200-day moving average, just to keep it simple, is a pretty big warning sign. I like to look at market breadth and how many stocks are above their 200-day moving average. We've actually done a lot of back testing on that data. And once you hit on the S&P 500, once 48% or less stocks are above their 200-day moving average, that's where you tend to get forward negative returns on a 12-month basis. I think they dropped to on an average, about negative 7%. And we're moving in that direction. So those are concerns. We're not at that threshold yet. And then, of course, what are the macro field conditions? Right now, you have the 10-year potentially retesting 5%. A breakout there would be problematic, I think, and potentially signaling more toward rate hikes than rate cuts. And then the dollar moving higher as well. So it's really an overall weight of the evidence approach. But I think for simple people at home, watch the 200-day moving average on the S&P and some of those breadth metrics.
We have inflation data coming out this week here, first inflation readings of 2025, and a lot of people obviously are going to be hanging on that and what that might imply for the Fed going on later this month for the first meeting of the year. When you're looking at the inflation data, I mean, I guess where's the break point where all of a sudden it starts to be a concern again? I feel like inflation has been sort of at manageable levels. We sort of have this Goldilocks scenario. Where are we no longer in a Goldilocks scenario and we need to start being concerned, I guess?
I think we're just about there here when we look at some of the inflation metrics. We look at break evens or swap rates. This top panel is the 1-year swap rate for inflation using CPI. Not going to get too far into the structure of that, but as it moves higher, that means that's the market pricing in higher expectations for inflation. And David, if you're looking at this chart as a potential buy, I think you would buy the breakout here out of this bottom. It would suggest you're going to see further upside. And the same thing on the 2-year break even. That's the implied inflation rate over the next 2 years, getting close to 3%. If we start hitting new highs on these metrics, I think that's really a concerning sign for equity markets, and really alluding to the fact maybe the Fed's inflation battle has more room to go before they can start really cutting interest rates this year.
So, I mean, this has been a fantastic discussion, Adam, as always, and I really appreciate you coming on and sharing some charts and ideas with us. With this as the backdrop, right, which with a likely, I guess, potential pullback, but a risk of further downside, with a lot of question marks, with breadth deterioration and everything. How do you think about positioning? What are you telling your advisor clients in terms of how to navigate this kind of period? Is it wait and see mode, or are you taking actionable moves today based on this sort of macro backdrop?
Yeah, glad you asked that question. So right now we're recommending a benchmark or neutral weighting for U.S. equity markets, and I think if we get maybe down to the 200-day moving average, things are holding up and look constructive, where breadth starts to expand, you get a change in momentum. Maybe we would go to an overweight. If we start breaking through some of those support levels and things deteriorate, I think that would probably have an underweight discussion from our oversight committee. And then at the sector level, we continue to like communication services. That's one we've been overweight over the last year plus now. We like it. Not only do you get mega cap exposure and some of that large tech trade, we'll call it, but you also get some of those telecom names that continue or can act defensive if we get a further pullback here in the market. So kind of a barbell approach. The technicals look great there as well. And at really right now at a potential pullback opportunity as it retests a shorter term uptrend.
Some of those old telecom names, strong price performance, decent dividend as well, right? I mean, potentially a good mix of the two. Adam, this is awesome as always. I really appreciate it. I know you're busy working with the advisors at LPL, but I really appreciate you taking some time to share some charts and thoughts with all of us. Where can we point people to learn more about you and your work? I know you're on social media. What's the best place for people to find you?
So on social media, it's Adam_Turnquist. I'm on LinkedIn and X. Also, you can go to LPL.com. There's a research page dedicated to all of our content. So you can find all the public facing content there as well. And then I think I will see you maybe in Tampa tomorrow or Thursday for the CMT event. So
here's hoping. Adam, thanks so much. I appreciate it very much. Safe travels. We'll talk to you again soon. All right.
All right. Thanks for having me.
So there we go. What a fun conversation with Adam Turnquist. And again, talking to someone like Adam who does a ton of work behind the scenes, sort of preparing a general market view, but having a lot of detail behind those analytical points, I think was really, really fun to dig into a bit. You know, I really liked his comments about comparing short-term weakness to long-term deterioration and how to try to differentiate, you know, what has been a choppy start to 2025 versus what would be signs that would tell us it is a more, you know, negative, more bearish, persistent downtrend like we've seen in previous years. And I thought his comments about, you know, looking at key levels, looking at defensive sectors, looking at leadership and rotation, thinking about the impact of the dollar and higher rates, I think we're all really, really helpful in terms of making sense of all the information that we've been, faced with here in early 2025. You know, really liked his some of his charts comparing to the performance of the Magnificent Seven to the equal-weighted S&P, thinking about breadth conditions, but what they actually mean for the major benchmarks. And I thought some of his charts and comments along those lines were very, very well said. End of the day, I think that was a fantastic history lesson. I really appreciate Adam's work differentiating, comparing 2024 to previous bull market years. I think that was one of my key takeaways, was really thinking about what the conditions are here in early 2025 and not just blindly comparing 2024 to other bullish years, really thinking about where conditions are similar. Now there's, it's not a perfect comparison, right? And who knows what will happen tomorrow. But I think the best tools we have are to analyzing market history using technical analysis as the main approach. And I thought, again, today's guest, Adam Turnquist, did a fantastic job of that. So I hope you enjoyed that conversation. I certainly did. And I look forward to bringing Adam on through the course of 2025 to get an update on how the markets have played out relative to his expectations and some of those historical comparisons. By the way, if you want to understand more about this toolkit that Adam and I discussed, if you want to be able to prepare your own charts and really do your own thinking about how to analyze market conditions, breadth and sentiment, trend and momentum, and everything in between, our Market Misbehavior premium memberships may be a really good place to look. What a great gift to yourself to kick off 2025, the gift of more mindful investing. And you can only do that by really understanding behavioral finance, which is how we're wired, what's happening between our ears, and technical analysis, which is a practical set of tools to understand the world around us. And the premium memberships, which combine virtual courses on those topics, regular webcasts, which you will have access to, a members-only community where you can ask questions about some of these things, and frequent premium members-only reports like our weekly flight plan, like our monthly chart review, that really demonstrate how we're applying those lessons, following market conditions as they evolve, looking for those trend changes and changes in character. That's the place to improve your understanding of all of the above. So if that sounds interesting, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for a special deal. We'll give you a discount on your first 12 months on any plan. Again, marketmisbehavior.com/premium, and make sure you use the code podcast when you check out for a special deal. That's it for today. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me. And remember, it's always a good time to own good charts.